Introduction. Good morning, everyone, and thank you for joining me today. In the next 7 minutes, we'll explore the most important economic trends shaping our world from July 2025 onward. We'll dive into global growth projections, the outlook for major advanced economies, central bank policies, commodity and currency markets, and finish with actionable strategies for investors. By the end of this talk, you'll have a clear framework to navigate the months ahead. 1. Global growth and trade outlook. Let's begin with the big picture, global growth and trade. After the post-pandemic rebound, growth is leveling off. Economists forecasting through 2026 expect world GDP growth to linger at around 2.4% annually. That's a modest pace, barely above the long-term trend, reflecting headwinds in both demand and supply chains. On the trade front, the story is even more subdued. World trade volume is projected to expand by just 1% in 2025, marking a significant slowdown from the double-digit growth seen in earlier years. As supply chain bottlenecks ease, demand growth also softens, leaving global commerce in a relatively flat trajectory. Emerging markets, however, offer a glimmer of hope. Collectively, they're set to grow at roughly 3.8%, driven by resilience in Asia and parts of Latin America. Domestic consumption, digitalization efforts, and infrastructure spending are cushioning the blow from weaker export markets. 2. Advanced economies, US, Europe, and UK. Now let's zoom in on the advanced economies. In the United States, growth is expected to slow to about 1.7% in 2025. Consumer spending remains solid but is facing headwinds from sticky inflation, which could hover near 3.5% by year-end. The Federal Reserve has signaled its intention to keep the federal funds rate anchored in the 4.25 to 4.50% range throughout the year, balancing the risks of overheating against those of a hard landing. Shifting to the euro area, growth looks fragile. GDP expansion is forecast at under 1%, with Germany playing a pivotal role. Berlin's accelerated infrastructure and defense spending, part of its post-pandemic recovery package, should provide a mild boost. Meanwhile, the European Central Bank is eyeing a modest 25 basis point rate cut in September, hoping to support credit conditions without derailing the inflation fight. Across the Channel in the United Kingdom, growth is expected near 1.2%. The Bank of England is likely to implement quarterly rate reductions throughout 2025, anticipating that inflation will gradually retreat toward its 2% target. Despite lingering concerns over household debt and energy costs, strong mortgage approvals signal that the housing market remains surprisingly resilient. 3. Monetary policy and financial market expectations. Monetary policy will be a key driver of financial markets in the months ahead. Markets currently price in about 65 basis points of Fed rate cuts by year-end, pushing the implied funds rate toward 3.6% in early 2026. In Europe and the UK, investors expect cumulative cuts of roughly 0.96% for the ECB and 2.15% for the BOE. Meanwhile, the Bank of Japan could trim rates by about 0.57% as it gradually eases its unprecedented accommodation. 3 major risks could disrupt these expectations: renewed trade tensions between the US and EU, geopolitical flare-ups in key regions, and stubbornly high inflation readings. Any of these events could force central banks to either pause or accelerate their planned rate adjustments, creating volatility in bond and equity markets. 4. Commodities and foreign exchange. Turning to commodities, an oversupplied oil market coupled with OPEC plus output increases suggests Brent crude could trade in the $55.62 per barrel range by year-end. Natural gas dynamics vary regionally, but Europe's ongoing transition to renewables may keep price spikes in check. On the currency front, the US dollar index is likely to remain under mild pressure as rate differentials narrow. The euro-dollar pair could test the 1.18 resistance level, supported by ECB rate cut expectations that contrast with an earlier Fed pivot. In precious metals, silver has broken above its long-term cup-and-handle formation around $34.85, signaling potential momentum for the next leg higher. Gold, meanwhile, remains a safe haven hedge against policy uncertainty. 5. Sector and thematic strategies. Given this environment of modest growth and evolving monetary policy, where should investors look? First, quality stocks continue to shine. Companies with strong balance sheets and pricing power can weather slowing growth while offering downside protection. Second, fixed income securities are regaining appeal as yields normalize. Short to intermediate duration bonds could benefit from a series of rate cuts without excessive duration risk. Third, thematic opportunities lie in digital finance and defense spending. Europe's launch of EUREU, its new euro-backed stablecoin, marks a strategic pivot toward digital money and blockchain infrastructure. Defense budgets in Germany and other NATO countries are on an upward path, supporting industrial and technology suppliers in that sector. Conclusion and key takeaways. To recap, global growth will hover near 2.4%. Trade growth slows to about 1%. The U.S. economy cools to roughly 1.7% growth. Fed rates stay at 4.25 to 4.50%. Eurozone growth underperforms at below 1%. ECB readies a 25 basis point cut. UK expands by 1.2% with the bow cutting rates quarterly. Oil trades in the $55.62 band. Euro heads toward 1.18. Silver shows bullish technicals. Favor quality equities, fixed income, digital finance, and defense themes. Thank you for your attention. I hope this framework helps you make informed decisions as you navigate the months ahead. I look forward to your questions and our discussion on these critical trends.